We're so glad you're here.
Likewise, Tim.
You've traveled a long way for just a few days, so thank you for doing that. In my home office, I have a Rand McNally map that is of the Asia reference, Asia and Pacific. And right smack in the middle of the map is Singapore. And so you're at the crossroads of the most populous and most dynamic part of the global economy. So your views on how you see economic trends and economic vibrancy is very important. We've been very Eurocentric today and a little bit yesterday, and we're going to transition a bit as the day progresses. But how do you see things from your front porch in what is an incredibly important part in the global economy?
Yes, thanks, Tim. It's probably a good way to start. I guess the primary challenge facing global economy is the rise in inflation and the steepness of its rise and the pervasiveness across various consumer prices. And central banks have to do what they have to do, but coming from a very highly accommodative position and then to cap the surge in inflation, which is so rapid, means we're seeing across the world one of the fastest pace of monetary policy tightening, coming from a very accommodative position and also highly synchronized across the world.
Right.
So the effect of this first is in terms of what it means for financial conditions across the world and especially in the emerging markets. Here I'd say that the large emerging markets are generally in a better place today than they were to deal with the tightening of monetary policy, compared to, say, during taper tantrum or even during the just before the COVID crisis. So you take countries like Indonesia, India, South Africa, the key large emerging markets, which have in the past faced some challenges with tightening of dollar strength, and if they also happen to be importing energy to a high degree, that is a bad combination. But they are generally in better shape, better macroeconomic founding, stronger reserve position, fiscal policies are good, and monetary policies are good. But what you're seeing is a very large number of smaller emerging markets who are having a tough time dealing with dollar strength, capital outflows, currency fluctuations, and inflation, food and energy inflation. I think Sri Lanka epitomizes this as an extreme example, but you have many Sri Lankas around the world. I think by some estimates, 60% of emerging markets are facing the prospect of crisis. So it's a serious situation. It's not systemic because, like I said, the larger economies, emerging markets are generally in a better shape, but the smaller ones are not. So the human suffering and toll on lives is not insignificant, but from a systemic global perspective, not as worrying as before. Having said that, I think we've not seen through the tightening of policies. Inflation has not quite peaked yet. And so this is some ways more to run, which means even the larger emerging markets will have to be on guard with the consequences that may come.
So what is your secret sauce? You have a small but dynamic and open economy. You have, as you said, it's a strong dollar, but the Chinese economy is very weak, maybe the weakest year we've seen since 1976. We had Kuroda-san on this morning to talk a little bit about Japan. How do you see the differences in trend growth or differences in growth trajectory, strong dollar, and then concerns about geopolitics in the region too?
Oh, yes. I think that if there are no further shocks, the expectation is that inflation will gradually start coming down over the course of 2023 in the major economies and in Asia. But that's a big assumption because what we have seen is that geopolitical shocks and disruptions to supply chains can permeate very quickly through into higher inflation. And so that's something we're all on guard against. I think there's much that governments can also do to help central banks. We are facing a demand and supply situation. Central banks are good at raising rates, and that constrains demand and brings demand back into balance with supply. I mean, inflation being basically a disequilibrium between demand and supply, and that's how central banks do their work. But because this is also a supply problem. Supply has come down and demand has gone up. We do need to address that part of the problem. And it doesn't help that more than 20 countries in the world have put in place a variety of restrictions, bans, or taxes on food supplies. And this is not good because it's going to have effects across the world. United Nations has estimated that close to 200 million people across more than 50 countries are in danger of some form of food crisis. So we have to watch this very closely. Food and energy prices at such elevated levels has consequences for livelihoods in many parts of the world. So governments, I think, need to play a part in boosting the supply side, opening up the supply chains and leading in. The other area of risk is labor markets. Right. Labor supply has gone through an unusual contraction and has not fully recovered. In some countries, it's the labor force participation rate. In other places, it's the slowdown in inflows of non-resident labor, and if you're dependent on migrant labor, that's a problem. In many other places, there are also structural factors of people choosing to go into part-time work and gig work.
Right.
Now, a lot of these things happening at the same time, it's hard to tell which of these are cyclical, which of these are the long tail of the recovery from the pandemic, and which of these are structural, going to be with us over the medium term. So I think the environment is fraught with inflation risk, high chance of a recession. I think the IMF has just said about a third of global GDP is at risk of recession.
Indeed.
That's the baseline. In a downside scenario, it will be a global recession. Both the fund and the bank have said that. Maybe a necessary price to pay to bring inflation down. And if it's a short-lived, shallow recession, that's not bad. Could be curative. But we must make sure that it does not extend through into a full-year recession that has then consequences for the following year.
You're a major financial center. We have an office there, which we're happy with. DBS is one of the world-class institutions. You have many there, including many of our other firms headquartered in other countries that have offices there. A lot of capital sloshing around the world, a tremendous amount of volatility, a lot of trading floors have never seen a rate increase or inflation. How do you think about financial stability in Singapore?
Well, in Singapore, it's something we watch very closely. At the root of most financial instability problems globally and in Singapore is leverage, high debt. And today, as monetary policy tightens and financial conditions become tighter, the key financial stability risk comes from those segments of the economy that are highly leveraged, especially if they have dollar-denominated debt. So borrowing is almost like the root of all macroeconomic evil in excess. Very briefly on Singapore, that's something we've focused on tremendously. We have very strong limits on, say, property borrowing, debt service ratios at 55%, loan-to-value ratios for the second property much lower, 60%. We have caps on loan tenures for housing. We have the world's strictest rules on credit cards usage, cap on how much you can borrow, and if you have not paid back when it's due, then there's a freeze. So a whole range of measures put in place to keep debt and leverage low. So I think, speaking for just Singapore, we should be okay. At a systemic level, there will be pockets of weaknesses in some corporates and some households, and we'll just have to deal with it. I think more broadly in the world, one of the challenges that central banks have is that they need to watch financial stability risks even as they try to contain inflation.
Right.
And the recent example in UK is very illustrative. The Bank of England has been doing the right thing, but now faced with the recent turmoil in the gilt market and what it means, not so much for the gilt market, but the pension industry. So you have non-bank financial institutions which have emerged as a potential source of risk. After the global financial crisis, we fixed the banks' issues. Banks are well capitalized and strong. The risk has migrated to a whole range of non-bank financial institutions. And they have become, in some sense, systemic. And so we do need to watch that space very closely and see what we can do to raise standards. And basically, if you ask me, find ways in which you can control leverage and debt.
Have we created an unreal set of expectations for central bankers? On the one hand, we're saying, do something about inflation now. Irrespective of the country, we have inflationary pressures globally. But don't do it too quickly. Don't be too aggressive. Don't take the punch bowl away. We still like drinking out of the punch bowl. Are we sending mixed messages, and therefore we're certainly likely to be disappointed one way or the other?
Well, the traditional dilemma that central banks have when they are tightening monetary policy is what it does to the economy. And I think to a large extent you must accept, as I said earlier on, you're trying to bring aggregate demand and aggregate supply back into balance. It does mean growth has to slow down. Now, of course, most central banks don't want to do that, tip the economy into recession, but sometimes that's necessary. If you recall Paul Volcker in the 80s, when he tamed inflation, it was double-dip recession in the US. Oh, yeah. I can't recall the unemployment rates, but that was a deep recession. That's what it took to tame inflation. Central banks don't want to repeat that. So the sooner you move to contain inflation, the better. Because if inflation is around for 4 or 5 years, as it was in the 70s and 80s, you have to work really hard and at great expense to the economy and labor market, which you don't want to. So I think central banks are right to move early rather than later and more forcefully before the economy starts weakening. And we all hope it will be a soft landing. There is a good chance it may not be.
Right.
But what's more important is the resilience of households and corporates to ride through a recessionary patch.
Another challenging issue is...
And of course, the second dilemma is what I just mentioned. You used to have the dilemma between growth and inflation. Now it's also inflation and financial stability.
Right, that's why.
So that's more complicated.
The other great issue we're wrestling with is climate change, and you're the chair of the NGFS. It's an important instrument and body in thinking through climate risk and climate policy. What are your set of priorities, and what do you hope to accomplish in that position?
Well, the first order of business is to attend to risk, because that's what central banks and supervisors are in for. So we want to make sure the financial sector globally is resilient to climate change, both the physical risk of climate change, which is already happening in many parts of the world, including here in the United States, and the transition risks, the technological changes that are going to happen, the business process changes that are going to happen, the stranding of assets, the move away from fossil fuels, carbon prices of varying sorts. All of these represent transition risks to the balance sheets of financial institutions. And so the first order of business for the NGFS is to attend to that, build up the climate resilience. Scenarios are a good way to do it. The NGFS climate scenarios are used to draw stress tests and to see what the effects of these risks are on banks' balance sheets, and then to take corrective actions. But I think beyond that, we also have a responsibility to green the financial system so that the financial sector is a force for change, positive change, to help the transition of the real economy towards net zero. And time is running out. Temperatures are still rising. We are at 1.1 degrees Celsius above pre-industrial levels. The chances of capping it at 1.5 degrees, frankly, look quite slim at current trajectories. Emissions are still rising. They need to come down 45% in 2030 relative to 2019 levels. That's not happening. Mm-hmm. So I think we need to work doubly hard, and this is where one of the initiatives we have pushed for is stronger public-private partnerships and blended finance. Mm-hmm. Public capital must act as catalytic capital to draw in more private capital. Today, the problem, especially, and I speak for Asia, many projects are just below the waterline with respect to bankability. To push them above to bankability, somebody has to take a little bit more of the risk. Not all of the risk. The private sector needs to play its part. But I think if you use public capital balance sheets as catalytic, go for below market interest rates, right, take a bit of the risk sharing, you have a good chance to draw in a lot more private capital. And you need to synergize across banks and institutional investors. Institutional funds want to be in this space, but they're not going to invest in a solar farm or a wind farm. Banks do that well. But the banks, because of the current regulatory rules, will then have to offload these loans, securitize them in a form that the institutional investors can take. So there's a whole lot of effort that needs to be taken to make this work. I think it can, but it requires a lot of will on the part of both the public and private sectors to come together.
Well, you've launched us on the blended finance highway. As you know, we've responded to your request. We have a blended finance handbook we're putting together. We hope to be working with Asia Development Bank and doing some things maybe in Seoul next year at their annual meetings, if not sooner, in order to pursue this. What more needs to be done? What should we try to accomplish over the next 60 to 90 days to ensure that in fact this project really accelerates?
Well, Tim, as you said, first, I think we need to learn the lessons of the past. This is not a new innovation. This is not rocket science. Blended finance has been around, but they've never been scaled. Some have worked well, many have not worked well. So we need to learn the lessons of the past, and the handbook is an effort to do this. Having done that, I think there is a need to do some learning by doing. So we are thinking of demonstrative projects to apply some of these principles. Say if you take Asia, one of the priorities, one of the needle-moving moves is to gradually phase out of coal.
Right.
Now, you can't do that in a hurry without serious disruption to social and economic development. Millions, hundreds of millions of people don't have access to electricity in the emerging world. So coal is a reality, but you need to have a strategy to transition out of coal over time, to retire and decommission coal plants over a period of time. Now, that calls for a fair amount of innovative financial structures. Who is going to bear that risk?
Right.
And the carbon credits that are generated later on when you decommission early, what is a pathway towards renewables? Because at the rate coal plants are being built in Asia, they're going to be around for the next 20, 30 years.
Right.
And if they're going to be around for 20, 30 years, the world will not reach net zero. So we need to have a strategy to do that. And I think that is one of the key areas we want to focus on, using blended finance solutions where there's an equitable sharing of the risks. And you need the support of national governments and provincial governments to make sure that the decommissioning takes place. And there's just transition to help the communities who are going to be affected by the winding down of coal plants.
And there's a role for MDBs as well. I mentioned the Asia Development Bank, which I know is engaged in looking at coal, decommissioning coal in Indonesia. Should the MDBs be using their balance sheets in a more aggressive fashion?
Absolutely. I think that is the most critical piece. And this has often been discussed, and several of us are pushing this idea. But basically, the major shareholders of the MDBs need to come to an agreement that they are willing to put part of those balance sheets at some risk. They need to do that. It cannot be that MDBs do what the banks are doing, which is to finance bankable projects for a decent return on their capital and to maintain their ratings. The bulk of the projects, as I said, are below bankability.
Right.
So they need to put a bit of their capital at risk to crowd in private capital. Their KPI should not be how many projects they finance. Their KPI is for every dollar of MDB capital, how many more dollars of private sector capital have I brought in, and how much carbon emissions have I reduced?
Right.
That should be the KPI. Of course, you're not going to take undue risk with your balance sheet. You need to raise capital, and that requires a good rating. But I do think we need to shift. And if we can do that, I think we'll make huge progress in the journey to net zero.
In addition to being a leader on climate and climate finance, you're also a leader on all things digital.
No,
and you have the FinTech Festival coming up in just a few weeks,
Yep.
and I'll be there on the front row, as we've been in the past. We're a knowledge partner with the MAS and others. How do you see, and you see we got FTX and Circle and a whole host of other firms similar to that are members, how do you see the crypto space developing and evolving? How do we encourage innovation and do it in a safe and sound fashion?
Yeah. So, as with all technologies, They are double-edged. They come with risk and opportunity. And I think to reject technology because we are afraid of the risk is not wise, but to embrace it blindly without a recognition of the risks is also foolhardy. And that's a very tough balance to strike. Each country is trying to strike it, and in Singapore we're trying to do the same. I would make one distinction that we found very helpful. One, think of this as crypto assets or digital assets. An asset that is either real or financial or even intangible that you can tokenize and put on a blockchain or distributed ledger. And the key innovation here is that the ownership rights over that asset can be tokenized and represented as a digital token. Now, that's a very powerful idea.
Right.
Some say more powerful than securitization, because you are able to monetize assets which you could not do so before. You're able to fractionalize those assets. So I think there is great potential there in tokenizing assets and monetizing them, having them exchanged, and creating economic opportunity and financial inclusion. Unfortunately, and this is where we're quite, let's say, disappointed, is that the native digital currencies that are used to power these distributed ledgers, cryptocurrencies in popular parlance, have taken a life of their own.
Right.
They're meant to be utility to be used to power the distributed ledger, but they've taken a life of their own as a vehicle for speculative investment. And large numbers of people have gone into them to invest with the expectation of a gain with absolutely no relationship to the underlying blockchain or what is going on in the blockchain.
Right.
This is deeply worrying. And in Singapore, we've taken a very tough stance. I know some call us schizophrenic because we are, on the one hand, promoting blockchain technology, use cases, and so on. And then on the other hand, we are trying to clamp down on private cryptocurrencies. I think the position is consistent because we are trying to promote the blockchain and the use cases on it, say cross-border payments,
right,
cross-border trade finance, pre- and post-trade capital market activities, all of which benefit tremendously because of the seamlessness, the security that the blockchain provides, and the digital assets do. But we are clamping down on retail access to cryptocurrencies because it's a very harmful investment, it's hazardous, and we think that is not a place to go. It also poses other risks, market integrity risks, the way some of these exchanges function. So it's a two-pronged approach of trying to promote the benefits and actually working closely with the industry, some of these names here,
right,
actively collaborating with them to make these use cases happen, but at the same time trying to control the risks. So, like I said, it's a tough balancing act, but people need to understand crypto is not just about cryptocurrencies that are traded on exchanges where you can make a quick buck.
right.
It is about the use cases that are possible, trade finance, the back office of bank operations, and so on, where digital assets can play a powerful role.
Different jurisdictions are progressing at different speeds. Europe is moving at a pretty fast pace. The US, we're fragmented regulatory systems, so the SEC versus CFTC versus the OCC. Are there certain jurisdictions that you look to for guidance or for best practices that you think as you might import regulatory regimes into Singapore, or are you simply going to make it up on your own?
Well, this is such a nascent area. We carefully study what most major jurisdictions are doing. This is not just crypto, but almost everything we do. We are unabashed copiers from the best that every jurisdiction has to offer. And so we do learn a lot from what others are doing. But we combine them in a way that I would say is uniquely Singaporean to fit our circumstances. So I think one of the areas we are keen on is stablecoins, private stablecoins.
Right.
Fully secured, very fully secured, I think have a role to play. Because what you need to power these distributed ledgers is a medium of exchange, a crypto medium of exchange. Now, we believe stablecoins can perform that role. Central bank digital currencies, wholesale CBDCs can perform that role. Tokenized bank deposits can play that role. All of them have the advantage of being pegged to fiat currency. So they have properties of money, and they can be used to power the asset, the blockchain. The fourth one, private cryptocurrency, is where the problem is. And there we are also looking at what other jurisdictions are doing with respect to putting in place market integrity requirements, disclosure requirements, suitability tests, and so on. In some areas, we've gone further. We've banned advertisements, and we'll be announcing another set of measures in the coming weeks. So when it comes to protecting the retail customer, generally, we've gone beyond others, except for those few jurisdictions which have banned cryptocurrencies, like China and India.
Right.
We've not gone that far. You can't ban it because you just have to whip out your mobile phone and you can buy this stuff from any exchange in the world. But we're putting a lot more sand in the wheels for retail access.
In my last minute and a half, I've got a tough question for you. Several years ago, you and I were at the San Francisco Fed conference, the one that you do between MAS and San Francisco, and you gave a very great speech about your point in the future looking back. Do you remember your speech?
Yep.
So that was written at that time, looking back then. If you're doing the same thing, replicating the same idea, and it's 5 or 10 years from now, looking back on this era, what do you think the key components are going to be? What are going to be the lessons we're going to learn over the next couple of years?
I have been thinking of a similar speech which pretends we are in 2040 looking back, and basically is a postmortem on why we did not avoid climate change. Because I think if the world goes on its current trajectory, we're going to see massive climate change over the next 5, 10, 15 years. And when we look back, why didn't we stop it? It will be a recounting of all of us collectively not coming together to do our part. Financial institutions and banks could have done more. Institutional investors today, everyone has a good reason why they can't do. Right? Fiduciary duties to your stakeholders and shareholders, not willing to sub-optimize your returns in the short term for longer term gain. The multilateral development banks, by being too narrowly focused on protecting their capital, their ratings, and not be willing to put some of that capital at risk to crowd in private capital. National governments, for not raising carbon taxes, not putting a price on carbon, without which a lot of this can't happen. Regulators and supervisors for being overly conservative in how they set their own capital requirements. And so I think it'll be a sad speech because we only have ourselves to blame, and we have all of us to blame collectively because we've not stepped forward, stepped outside of our current confines, current mental models, current objectives and mandates. But if really climate change is the existential challenge of our times, then it's something that all of us need to step up to. I hope that speech would not have to be given.
Well, if you give it, we'd love to host it. Even we take negative speeches too. But we hope that you consider it. And I look forward to seeing you in Singapore in just a few weeks. It should be fun. It's been a few years since I've been there.
Absolutely. For the Singapore FinTech Festival.
Yeah, well, I'll be there. We're a knowledge partner. Come with me. Ladies and gentlemen, Ravi Menon from the MAS.
Thank you, Tim. Thank you, everyone.